Hello again. Today at Save to Invest, we'll look at the pros and cons of our first major strategy for investing. What is an investment strategy? An investment strategy is a set of principles that guide investment decisions. The decisions depend on factors such as risk tolerance, investing style, long-term financial goals, and access to capital. There are various investing plans that can be followed. Investment strategies are adaptable. If you select one and find that it doesn't align with your risk tolerance or schedule, you have the option to make changes. However, changing investment strategies comes with a cost. Each time you buy or sell securities, particularly in non-sheltered accounts and within a short-term time frame, taxable events may occur. It's also possible to realize that your portfolio carries more risk than desired after your investments have decreased in value. In this context, we will examine 4 commonly used investing strategies that cater to most investors. The first one we'll do in this video, the others in subsequent videos as part of this series. By taking the time to comprehend the characteristics of each strategy, you will be able to select one that suits your needs in the long run without incurring the expenses associated with altering your course. Before developing a strategic plan, it is essential to gather information about your financial circumstances and objectives. For individuals pursuing value investing, a long-term commitment and rigorous research in stock selection are crucial. Growth strategy adherents must stay vigilant regarding executive team performance and economic news. Meanwhile, momentum investors opt to purchase stocks on the rise and consider short-selling possibilities. Lastly, dollar-cost averaging involves consistently investing in the market over time. Prior to delving into investment research, it is crucial to collect essential details pertaining to your financial standing. Reflect upon the following significant inquiries. What is your existing financial state? What are your monthly expenses, debts, and overall cost of living? How much are you capable of investing, both initially and consistently? While a large sum of money is not necessary to commence investing, it is essential to wait until you can comfortably afford it. Prioritize examining the effects investing will have on your short-term cash flow if you possess any outstanding debts or obligations. Only then should you consider allocating funds towards your investment portfolio. To effectively plan your investments, it is crucial to first establish your goals. Everyone's financial needs and aspirations vary, so take the time to identify what you are aiming for. Are you primarily saving for retirement, or are you focused on making significant purchases like a house or a car in the future? It could also be that your main objective is to accumulate funds for your own or your children's education. Understanding your specific goals will enable you to narrow down a suitable investment strategy, as different approaches carry varying levels of liquidity, opportunity, and risk. After mapping out your goals, it is important to assess your risk tolerance. This factor is determined by 2 primary elements. Firstly, key factors such as your age, income, and proximity to retirement typically play a role in determining your risk tolerance. Generally, younger investors have more time to recover from any losses, making it advisable for them to embrace more risk than older investors. Secondly, risk tolerance is highly influenced by psychological factors and emotions. Ponder on how you would emotionally react if your investment suddenly dropped by 30% overnight, or if your portfolio decreased by $1,000 in just one day. Sometimes the most profitable strategies in investing can cause discomfort and worry. If you find yourself constantly anxious about potential losses, there is a chance that your portfolio might contain an excessive level of risk. Achieving a balanced investment approach requires a careful consideration of both your goals and risk tolerance. By recognizing what you are aiming for and assessing how much risk you are comfortable with, you can better formulate an investment strategy that aligns with your financial aspirations and emotions. It is crucial to comprehend the significance of risk and rewards. Investing does not inherently pose a negative outcome through risk. Investments with higher risks are frequently accompanied by greater returns. Conversely, investments with lower risks are more likely to maintain their value, but may not possess the potential for significant gains. Moreover, familiarize yourself with the fundamental aspects of investing. This entails acquiring the ability to interpret stock charts, initially selecting some preferred companies, and analyzing their financial statements. Remain updated with recent news related to the industries you intend to invest in. It is wise to possess a basic understanding of your investment pursuits to avoid uninformed decisions. Today we'll look at our first strategy for investing in stocks. This is called value investing. This strategy involves looking for stocks that are believed to be undervalued. Value investors think that these stocks are priced lower than their actual worth. They believe that the market sometimes makes mistakes and doesn't accurately reflect the true value of a stock. By identifying these undervalued stocks, value investors can buy them at a discounted price and potentially make a profit. Value investing doesn't always require extensive research. Many value mutual funds are available, allowing investors to own a portfolio of stocks that are considered undervalued. These mutual funds often follow benchmark indices such as the Russell 1000 Value Index, which is commonly used in value investing. For those who want a quicker way to identify undervalued stocks without extensive research, the price-earnings ratio can be helpful. This ratio is calculated by dividing a stock's share price by its earnings per share. A lower price-earning ratio means that you are paying less per $1 of current earnings. Value investors typically look for companies with low price-earning ratios, as these stocks may be considered undervalued. Value investing is a strategy that is well suited for investors who have a long-term investment horizon. This approach involves investing in companies that are considered undervalued and have the potential to grow over time. It requires patience, as it may take several years or even longer for these companies to realize their full potential. Value investors focus on the bigger picture and adopt a gradual growth mindset when it comes to their investments. Warren Buffett, a renowned investor, is often seen as the epitome of a value investor. He once made a significant investment in the airline industry and explained his decision by stating that airlines had a difficult first century, but he remained optimistic for the future. This mindset reflects the core principles of value investing, which involve analyzing decades of trends and considering the potential for decades of future performance. Note here what I said in a previous video. Buffett started from wealth, and that means he is a different level. Never compare your own circumstances to someone like that if you are not at their level. It's like a lower league soccer or football player comparing themselves with Bayern Munich's leading goal scorer or the Dallas Cowboys quarterback. While value investing has historically generated superior returns over the long run, it has also experienced periods of underperformance compared to growth investing. Research conducted by Dodge & Cox identified 3 instances in the past 90 years where value strategies lagged growth strategies during the Great Depression, the technology stock bubble, and the period from 2004 to 2014-15. In fact, since 2007, value investing has consistently underperformed, resulting in a drawdown of more than 50% by 2020. As for the future, it remains uncertain whether value stocks will regain their previous appeal. Only time will tell if value investing will once again shine soon. What are the pros of value investing? One of the main advantages of value investing is the potential for long-term gains. As the market gradually recognizes a value company's true intrinsic value, there is an opportunity for substantial profit. By identifying undervalued stocks, investors can benefit from buying them at a discounted price and holding them until their value is fully appreciated. Another benefit of value investing is the stronger risk-reward relationship that value companies often exhibit. Compared to growth stocks, value stocks tend to have lower levels of volatility, making them less prone to sudden price fluctuations. This can be attractive for investors who prefer a more stable investment option and are willing to accept potentially slower growth in exchange for reduced risk. Furthermore, value investing is grounded in fundamental analysis and supported by financial metrics. This approach involves thorough research and analysis of a company's financial statements, competitive position, and industry trends. By focusing on these fundamental factors, investors can make more informed decisions based on the financial health and potential of the company, rather than relying solely on market trends or speculation. Additionally, value companies are more likely to issue dividends to their shareholders. These companies often prioritize providing returns to their investors through regular dividend payments, as they are less reliant on using their cash for aggressive growth strategies. For income-oriented investors, this can be a significant advantage as it provides a more consistent stream of income from their investments. What are the cons of value investing? One of the main drawbacks of value investing is the challenge of finding potential value companies, particularly considering the possibility of inflated earnings due to accounting practices. Identifying undervalued stocks requires in-depth research and analysis, which can be time-consuming and complex. Furthermore, financial statements can be manipulated to present a more favorable picture, making it difficult to accurately assess a company's true value. Another con of value investing is the necessity for patience. Successful value investments often require a long-term perspective, as it can take time for the market to recognize and reflect the true value of a company. Investors must be willing to hold their investments for an extended period, even during periods of underperformance, to potentially realize the expected gains. Finally, even after holding a value stock for an extended period, there is no guarantee of success. The company may face unforeseen challenges or decline in value, potentially resulting in a worse situation than when the investment was initially made. This underscores the importance of thorough research and careful selection when choosing value companies to invest in, as there are no guarantees in the stock market. Furthermore, investing exclusively in underperforming sectors for value stocks can decrease the diversification of a portfolio. By limiting investments to certain sectors, investors may not fully benefit from the potential growth and stability provided by a more diversified portfolio. It is essential for investors to carefully assess the balance between value stocks and other types of investments to maintain a well-rounded and diversified portfolio. If you're enjoying our content, smash the like button and subscribe. Consider using our links in the notes. Thank you for watching.